Hello all my dear students, I hope you all are doing good. So finally the wait is over and ICAI has finally released its MCQ booklet relevant for your exams of May 23 and also for November 23 you can say. So one genuine advice that I would like to give you is, in this video I am going to discuss all the MCQs which are there in this new booklet in English, in complete English for my South India students. Don't worry about it. And don't worry, your revision videos are also coming soon. Exhaustive revision videos with discussion on practical questions coming soon. The way I have done it for PGBP, I'll be doing it for other topics as well. For the entire syllabus, by the end of this month, the entire syllabus will be uploaded. Don't worry. But let me speak few things about the MCQs. Now, regarding the MCQs, this booklet has to be done by all of you. And in this video, we are going to discuss the reasoning of each and every MCQs given by the ICAI in this booklet. So, what should be your approach? Your approach should be to first complete the booklet at your end, and then you can come to this video and watch my discussion on the MCQ. If the time is constrained, then you can directly watch this discussion. But if time is not a constraint, then advisable it is to first go through the booklet at your end, and then you can come to this booklet, to this video, and then you can understand the reasoning of each and every MCQ. But more importantly, I would like to tell you that more important than this booklet is the booklet of last year, which was relevant for May 22 and November 22 because there were a lot of questions over there. Plus, this booklet only contains individual MCQs. It does not contain case scenario MCQs. The booklet which was released by ICAI in the last year, that is for May 22 and November 22, that even contains case scenarios. Lot of case scenarios were there. So I advise you to go through that booklet also. I will try and I will upload a video for that booklet also in full English very soon after I am done with the revision videos. So for Hindi students it's already uploaded, but for English also I will try to upload the the MCQ reasoning for the last year booklet also. Don't worry about it. Okay, you have to do just one thing, just follow our channel and just see what all things that I put for you all. That will be the maximum things that anybody will put for you all in the entire country in English content. I'll try to put everything in English content, whatever I put for Hindi content. So without wasting any further time, let's start with the first MCQ. In this first MCQ, there are two persons, Mr. Rajesh and Mr. Brajesh. Now, Mr. Rajesh has purchased a life insurance policy in 2012. And Mr. Brajesh has purchased the life insurance policy in 2012, that is in April. So now they are receiving some money from the insurance company. That is how much they are receiving, 13 lakh rupees from insurance company. We need to answer whether it is taxable or if it is not taxable. And if it is taxable, then whether the TDS will be deducted or TDS will not be deducted. That question we need to answer. So now the answer is, let's talk about one by one. In case of Rajesh, it is not taxable. Sir, why? Because Rajesh has purchased, has bought the policy before 2012. And if you remember, if you buy the policy between 1st April 2003 to 31st March 2012, then if your annual premium does not exceed 10% of sum assured, 20% of sum assured, then it is not taxable. So in this case, the policy is purchased till 2012. So you will get a cap of 20% of sum assured. What is the sum assured? 10 lakhs. So your premium can be up to 2 lakhs. But your premium is just 1.1 lakh. Therefore, Mr. Rajesh is exempt under 1010D, and because he is exempt, the question of TDS does not arise. Now, in case of Mr. Brajesh purchased on 1st April 2012. During that period, from 1/4/2012 to 31st March 2013, the percentage got changed. In that period, the percentage is only 10% of sum assured. Now, you are paying 11% of sum assured because you are paying 1.1 lakh and your sum assured is 10 lakhs. Therefore, you are taxable. Now, how the income will be taxed? How the TDS will be taxable? How the TDS will be deductible? TDS will be deductible under section 194D, DA. How? Whatever amount company is paying you 11 lakhs, 13 lakhs, minus whatever premium you have paid over the years. You have paid a premium of 11 lakhs over the year from 2012 to 2022. You have paid premium of 11 lakh. How, sir? 10 years, every year 1.1 lakh. So the premium comes to 11 lakhs. So whatever amount the company has paid you, 13 lakhs minus whatever amount you have paid to the company in the form of premium, that is 1.1 lakh into 10 years, that is 11 lakh. The differential amount is subject to TDS of 5%, and therefore in this case the TDS is how much? The TDS is only 10,000 rupees in case of Mr. Brijesh, and in case of Rajesh there will not be any TDS, because in case of Rajesh the amount received is exempt because it is within the ceiling of what? 20% of sum assured, because the policy is issued before 2012. I hope you got it. These MCQ reasoning will not only help you to understand why this is the answer, but will also improve your knowledge of the subject. Okay. Let's discuss MCQ number 2 now. In MCQ number 2, ABC Limited is a company who has taken on lease two things. One, he has taken on lease building with effect from 1st July 2022. So he is paying the lease for 9 months. For 9 months, he'll be paying lease of how much? 1,80,000 rupees. Apart from that, he has also taken on lease machinery from October. So from October, he will be paying 15,000 per month rent for machinery. That will be how much? 15,000 into 6, 90,000. Taking together both of them, it crosses 2,40,000. So TDS will be deducted under 194I, because in 194I, the aggregate limit of building, plant, machinery, furniture, land, everything taking together should exceed 2,40,000. It is exceeding definitely. So you will deduct TDS of 10% on building. For building it is 10%, that is 1,80,000 into 10%. And for plant, machinery and furniture, plant and machinery, sorry, not furniture. For plant and machinery equipments, the TDS rate is 2%. So 1,80,000, 10% and 90,000, 2%. Apart from that, there is also security deposit which is refundable. Now remember, if there is a security deposit which is refundable, then TDS is not applicable. But if it is a non-refundable security deposit, then TDS is applicable under 194I. It is written in our easy notes. You can go and check. So security deposit which is refundable, it is not rent because it is refundable. Therefore, it is not subject to TDS. So ultimate answer, what is the answer? That on 1,80,000 you will deduct 10%. On 90,000 you will deduct 2%, excluding the security deposit, because security deposit is a refundable amount. It is not subject to TDS. Okay, go through it. Question number 3. Mr. Valish is employed as a manager and he pays rent of 50,000 rupees per month to landlord. Now, the question is he liable to deduct TDS? Listen carefully. Where does the TDS of rent goes? It goes in first of all 194I. 194I is not applicable. Why? Because Mr. Valish is not doing business. In case of 194I, it is applicable to individual and HUF only if their turnover of business of the last year is greater than 1 crore, or if they are engaged in profession, their professional gross receipt should exceed 50 lakh rupees. Then only 194I is applicable. Therefore, 194I is not applicable because Mr. Valish is an employee of a company and he is earning income from salary. What about if I is not applicable, then IB? Even 194 IB cannot be applicable, because for 194 IB, the rent per month has to be greater than 50,000 rupees. If it is exactly 50,000 rupees, then 194 IB is also not applicable. So I gave you the reason for both. Why 194I is not applicable? Because Mr. Valish last year turnover is 0 rupees because he is not doing any business. Why 194 IB is not applicable? Because Mr. Valish is not paying more than 50,000 rupees. He is paying exactly 50,000 rupees. Can you imagine how ICAI is playing with the numbers over here? Exactly, they are putting 50,000. Therefore, answer is D. That is, Mr. Valish is not liable to deduct TDS. Check it, please, all of you. Question number 4. Mr. Hari is an interior decorator in this question, and he is following 44 ADA in the current year also, in the last year also. It means definitely his gross receipt of the last year is less than 50 lakhs. And therefore, 194H is not applicable. 194C is not applicable, and therefore the only option which is available for him is 194M. Because for 194H, 194C, 194I, 194J, 194A, all these sections, if you are individual HUF, your last year turnover has to be greater than 1 crore in case of business and 50 lakhs in case of profession. And both is not happening because he is following 44 ADA. And if he is following 44 ADA, then definitely his last year's turnover is less than the limit of 50 lakhs. Then, can he go for 194M? Even 194M cannot be made applicable, because for 194M, you have to make the payment to a person of more than 50 lakh rupees. Then only 194M is applicable. Here, he is making a payment to Mr. Lal of brokerage of only 10 lakh rupees. So, this will not be subject to 194M. To Mr. Sham also, he is making payment of exactly 50 lakh rupees. It should exceed 50 lakh rupees. Then 194M is applicable. So, even 194M is not applicable. So, I'll just conclude it. 194H is not applicable for brokerage because last year's turnover is less than the gross 50 lakhs. 194C is not applicable because you are making the payment for residential purpose first of all. Okay, you are constructing the house for residential purpose, therefore 194C is not applicable. Second reason 194C is not applicable because last year's turnover is also less than 50 lakhs. Next, 194M is also not applicable because for M the payment has to be greater than 50 lakh rupees to a person. So you are making payment to Mr. Lal of only 10 lakh and Mr. Sham only 50 lakhs. If you would have made both the payment to one person only now, if you would have made entire 60 lakhs to Mr. Lal or entire 60 lakhs to Mr. Sham, then 5% TDS would have been deducted in 194M. But in this case, you are making the payment to two different persons. Check it please. Therefore, no TDS on any of the two transactions. You are exempted from both the TDS. Okay. Let's move on to question number 5. Here also there is a question of TDS. Mr. Sanjay is making he is a salaried employee. Suppose if he is a salaried employee, then 194H cannot be made applicable. 194H is applicable only for PGPP SSE. That too if last year's business turnover is more than 1 crore or if professional turnover is more than 50 lakhs. Otherwise 194H is not applicable. Therefore, for Mr. Sanjay, H is not applicable. For Mr. Sanjay, M will be applicable. Even M will not be applicable because he is not making payment in excess of 50 lakh rupees. So Mr. Sanjay is not liable to deduct TDS. Let's talk about his father Hari. His father is also a retired pensioner, so he is also earning income from salary only. So for him also all these provisions are not applicable. 194A, 194C, 194H, 194I, 194J, all these provisions are not applicable. Okay. So for him, is 194C applicable? He is making a payment of 52 lakhs. Is 194C applicable for him? For him also 194C is not applicable because he is making the payment for personal purpose, and if you make the payment for personal purpose 194C is not applicable. But for him, is 194M applicable? The answer is yes. For 194M, your payment for even personal purpose, if it exceeds 50 lakh rupees, you are liable to deduct TDS at the rate of 5%. And for M, for Mr. Hari, 194M would be applicable. So what is the ultimate conclusion? Sanjay will not deduct TDS under any provision, but Hari would deduct TDS under 194M. And therefore, the answer to this question is point number D. Check. Question number 6. Kunal and LLP is withdrawing some 1,25,000 rupees from the bank account. Okay. And they are regularly filing the returns. So if they are regularly filing the returns, then the threshold for them under 194N is how much? It is 1 crore. And if they have not filed the return for the last 3 years, then it is 20 lakhs and then 1 crore. But they are regularly filing the return. So in excess of 1 crore, whatever amount they have withdrawn, 2% TDS bank will deduct. So in excess of 1 crore, how much they have withdrawn? They have withdrawn 25 lakhs. So on 25 lakhs, 2% will come to how much? 50,000, and therefore the bank will deduct TDS of 50,000, that is 25 lakhs into 2%. Check it please. Question number 7. There is a person by the name called as Mr. Ravish. Now he has withdrawn from Canara Bank in all 99 lakh rupees. Okay. And he has not filed the return for the last 3 years. Check. So if he has not filed the return for the last 3 years, then the threshold changes from 20 lakhs to 1 crore, then it is 2%, and above 1 crore, it is 5%. So if he has not filed the return for the last 3 years, here the TDS will be deducted as follows. 99 lakhs is the total withdrawal. So minus 20 lakhs, you have to give that exemption first. On 79 lakhs, you have to deduct 2% tax. That is, in excess amount, you have to deduct 2%. So on 79 lakhs, 2% TDS will come to how much? Will come to 1,58,000. And if he would have withdrawn more than 1 crore, then in excess of 1 crore, if he would have withdrawn more than 1 crore, then in excess of 1 crore, we would have deducted how much? 5% tax. But here he has deducted only 99 lakhs. Therefore, after 20 to 99, it comes to 79 lakhs. On 79 lakhs, 2% comes to 1,58,000. That is the amount of TDS that Canara Bank has to deduct. Okay. Next question number 8. Question number 8, Mr. Ganesh, again an individual, but his turnover for the last year is now more than 1 crore rupees. Therefore, 194J will be applicable for him. So if an individual whose last year's business turnover is more than 1 crore, 194J is applicable. Now in the month of April, he is taking some consultancy services from some chartered accountant or something like that. Okay. How much consultancy service he has taken? 1,84,000 consultancy services he has taken in the month of April. And therefore, in this case, 10% TDS will be deducted, and that TDS will be paid by 7th of the following month. So the answer is 18,400 has to be paid by the Ganesh because he is taking some services of 184. On that 10%, 18,400, and it has to be paid by 7th of the following month. Check it please. And therefore, the answer to this question is point number A. Next question, question number 9, whereby he is making 2 remittances. The person is making 2 remittances out of India. First is for overseas tour package program. He is remitting 3 lakh rupees for overseas tour package program. On that 5% TCS is collected. No exemption of 7 lakh on overseas tour package program. No exemption. Otherwise, you get an exemption of 7 lakh before collecting the TCS. But in this case, in case of overseas tour package program, no exemption of 7 lakh. So on 3 lakhs, you have to pay 5% tax. That is 5% TCS will be collected. Next, he has taken a loan from a financial institution in India for an education of his son outside in India. So if you are remitting the money outside India by taking loan from a financial institution, condition listen, if you are remitting the money outside India by taking loan from any financial institution in India and you are remitting that money for higher education outside India, then you get relaxation of 7 lakh also, and the tax rate is also 0.5% on excess of 7 lakh. So you are remitting 10 lakh rupees from taking loan, and then you are remitting outside India for higher education. So on that you will get first 7 lakh exemption, and on balance 3 lakh. Balance 3 lakhs, you are liable to pay only 0.5%, and therefore the answer to this question is D. Check it please. Question number 10. Question number 10, what is happening? Mr. Mahesh is a seller and XYZ Limited is a buyer. Now the seller's last year turnover is more than 10 crore and even the buyer's last year turnover is more than 10 crore. Check it please. And in that case, if the seller's last year turnover is more than 10 crore and even the buyer's last year turnover is more than 10 crore, and if the buyer buys more than 50 lakh rupees and if the seller sells more than 50 lakh rupees, then what will happen? Should the seller collect TCS or should the buyer deduct TDS? In that case, the CBDT has given a clarification that if the seller's last year turnover is also greater than 10 crore and if the buyer's last year turnover is also greater than 10 crore and if the buyer buys more than 50 lakhs and if the seller also sells more than 50 lakhs, in that case, the buyer has to deduct TDS. And the buyer has deducted the TDS. You can check. You may assume that XYZ complies with all his TDS obligations. Because XYZ has complied with all his TDS obligations, so no, since XYZ is liable to deduct TDS. Therefore, Mr. Mahesh is not liable to what? Collect any tax. Mr. Mahesh is not liable to collect any tax. Yes, if XYZ Limited would have not deducted the TDS under 194Q, then Mr. Mahesh would have been liable for what? Would have been liable for collecting tax. So between 194Q and 2061H, you have to give priority to 194Q. So here it is written that TDS obligations have been fulfilled, therefore TCS is not applicable. If TDS obligation would have not been fulfilled, then TCS would have been applicable under 206C1H. Okay. Question number 11, which is based on section 271 AAB, which is a special penalty provision in case of search and seizure. What government says? In case of search and seizure, suppose if something is caught and if you claim that this belongs to the specified previous year. So what is specified previous year? There are two specified previous year. One is the year of search, can be called as specified previous year. Another is conditional. Last year can be called as specified previous year if the due date of filing of that return of that year has not arrived and you have also not filed the return of income. So now in that case, if you find something today in the search and seizure and if you claim that this belongs to specified previous year, either current year or last year subject to some conditions, then in that case, you have to pay the tax, you have to pay the interest, you have to give a statement in section 132 subsection 4 explaining the nature and source of income from where you have got the money, and you have to prove that this income belongs to the specified previous year. And the fourth and the last point, you have to disclose that income in the return of income and you have to file the return of income on or before the date. Now, if you do all these things, then we will charge 30% of undisclosed income as penalty. But if you violate any of the one conditions, for example, if you are not able to explain the source, or if you have not paid the tax, or if you have not paid the interest, or if you have not disclosed that income in the income tax returns, if you fail to fulfill any of the conditions, then the penalty will be directly 60% of undisclosed income. And this is what the assessee failed to do. The assessee did not able to disclose that income in the return of income filed, and therefore the penalty leviable to the assessee will be 60% of the undisclosed income. Check it please. If the assessee would have fulfilled that point also, then the penalty will not be imposed on assessee. Now question number 12, there is some mistake in this question. Now what has happened? Let me explain you again. This question is on 271 AAB only. This question is targeted. It is assumed to be targeted on 271 AAB, but there is a very fine technical mistake in this question. Let me explain you. What happens? 271 AAB is only applicable for specified previous year. What is specified previous year? As I have told you, first specified previous year is the current financial year. The current financial year can be called as a specified previous year. Second specified previous year will be last year. subject to some conditions, that the due date of filing of return of that year should not come, and the assessee also should not file the return till the date of search. Then last year can become specified previous year. So last year can become specified previous year conditionally. Now, the problem over here is the search has happened on 20th December 2022, and definitely on that date, the due date of filing of return of 21-22 has already gone. The worst case scenario also could be what? The worst case scenario could be also of 30th November. That is also gone. So this 21-22 cannot be called as a specified previous year. And if 21-22 cannot be called as a specified previous year, then declaring this 50 lakh rupees as an income of 21-22 is of no use, because that is not a specified previous year only. So in that case, you cannot apply 60% of the penalty, 60% of the undisclosed income as penalty and show under 271AAB. 271AAB is not applicable only. Go and check the provision of 271AAB. 271AAB is applicable if you disclose the income as an income of the specified previous year. Now 21-22 cannot fall in the definition of specified previous year. Therefore, this section is not on 271AAB. In fact, here the provision of 270A should have been applied by the department, by the institute. Then the answer would have been correct. And in 270A, you could have take 200% of tax payable as your tax as your penalty, and accordingly that could have been the correct answer. But institute has found out a easier way, which is wrong, absolutely wrong. Here the answer cannot be 60% of undisclosed income, because this income which you are disclosing for 21-22 is not a specified previous year only. Check it please. Question number 13. Now in this question I don't have any problem, because in this question the search has happened in 22 May. So last year can be considered as a specified previous year, because the due date of filing of return has not come in May and the assessee has also not filed the return. So this can be considered, and in this case assessee has fulfilled all the conditions. Assessee has declared the income, assessee has explained the manner in which the income is derived, assessee has paid the tax, assessee has paid the interest, assessee has disclosed the income also in the return of income. So in this case the assessee will be liable with not 60% of undisclosed income but only 30% of undisclosed income. Check it please. Okay. So here the assessee is fulfilling this last condition also, which the assessee failed to fulfill in question number 11. Check it please. The next question, question number 14, speaks about power of income tax authority to collect information. When they come to collect information, they have certain powers. What all powers they have, what all powers they don't have, that we have to identify from here. Do they have the power of something like that they can enter only after sunrise but before sunset? No, there is nothing like this in the section of collection of information. Now this power is there in survey, not in collection of information. That is given in 133A. So this is not a relevant point for collection of information. Second, they can only enter during business hours at which such business is. Yes, this is the point which is mentioned in section 133B. This is the point which is mentioned for collection of information. Next, they can take the books for custody up to 15 days, and if they want beyond 15 days, then they have to take an approval of principal commissioner or commissioner. Yes, that is also a condition which is mentioned. That if the income tax authority wants to take the books beyond 15 days, then they have to take an approval of what? Principal commissioner or commissioner. And last but, they cannot take any books of accounts. Wrong. They have come to collect information. Yeah, they have come to collect books of accounts. They can collect books of accounts. They can collect books of accounts. They can take all these things. There is no issue in that. And therefore, the answer to this question is 2 and 3 is the correct answer. 1 and 4 is incorrect answer. Check it please. Okay. For this, you need to have a fine reading of the provision. Go and read it please. Now, question number 15 is on survey. Generally, what happens? The survey should start after sunrise. But it should, the authority can enter after sunrise only, but before sunset. This is the general provision. They should enter for survey after sunrise, but before sunset. But there is an exception, that if your working hours is in night, like in this case, the cyber cafe runs from 2 PM to 2 AM. The working hours, the business hours are in night also. So then they can enter even at 1 AM. They can enter at 1 AM. They can also impound your books of accounts, no harm. Up to 15 days, there is no need to take any approval also. So therefore, the correct answer is, can AO enter at 1 AM? Yes, he can enter at 1 AM. And can he impound the books of accounts? Yes, he can impound the books of account. Up to 12 days, there is no, up to 15 days, there is no need to take any approval also. Okay. Next question, question number 16 is a very good question. First of all, Mr. Ram was born on 1/4/1963. If some person was born on 1st April 1963, then 1st April 2023 is the 60th birthday. Okay. So in that case, CVDT says that the 60th birthday has started in the current year, but you have achieved 60 years in the last year only. 1st April 2023, you have started with your 61st year. It is not that you have completed 60 years today. 60 years you have completed on 31st March only. So if a person is having a 60th birthday on 1st April 2023, it means he has completed 60 years in the last year, and therefore in the last year itself, that is in 22-23 financial year itself, that person was a senior citizen, because on 31st March 2023 he has achieved what? He has achieved 60 years. And therefore if a person who has a 60th birthday on 1/4/2023 will be said to be as a senior citizen in the last year itself, that is in 22-23. And now if he is a senior citizen, when is he liable to file return? His total income should exceed 3 lakhs in that case. His gross total income should exceed how much? 3 lakhs. Now his gross total income does not exceed 3 lakhs. Therefore he is not liable to file return because of this reason. Second, is he liable to file return because he is going for a foreign tour? No. Because in that case, your foreign tour expense should be more than 2 lakh rupees. Here the foreign tour expense is exactly 2 lakh rupees. So, is not liable to file return because of this reason also. Is he liable to file the return because he is paying an electricity bill of 10,000 rupees per month, which amounts to 1,20,000 in the entire year? The answer is yes. Any person who pays more than 1 lakh rupees electricity fees in the entire year, electricity charges in the entire year, is liable to file the income tax return. So, he is not liable to file because of his total income. He is not liable to file because of the foreign tour, but he is definitely liable to file because of what? Because of the electricity bill, because the per annum electricity bill exceeds 1 lakh rupees. Okay. Next, suppose a person, assessment year 22-23, assessment year 23-24 is going on, and 30th September the assessee has filed the return. So what is the time limit to serve a notice under 143(2)? The time limit to serve a notice is within 3 months from the end of the financial year in which the return was furnished, and the return was furnished in what? 30th September 2023, which is 23-24. So the department should, the AO should serve the notice within 3 months from the end of the month, from the end of the financial year in which the return was furnished. So that therefore it has to be served within 3 months from 31st March 2024, and therefore the ultimately last date should be 30th June 2024. Within 3 months from the end of the financial year in which the return was furnished. So return was furnished in 23-24. So within 3 months from the end of 23-24 comes to which date? 30th of June 2024. Okay. Next, question number 18. While processing the return under 143(1), which of the adjustments are not mentioned over here, and which of the adjustments are mentioned over here? Arithmetical error? Yes, the return definitely processes the arithmetical error. Incorrect claim apparent from information in the return? Yes, it definitely. Any expenditure in the tax audit report and in the income tax return having mismatch, does it rectify that also? Yes, it rectifies. All these items are there in 143(1). You can go and check. Last, Form 26AS mismatch? No, that is not rectified in 143(1). That is the item which is not covered in 143(1). You can go and check. Okay. Question number 19. What has happened? CIT has passed an order for what? For penalty under 270A. Now, if I want to file an appeal against it. So, where do you file an appeal against the CIT's order? Against the CIT's order, you have to file an appeal to tribunal, and that too within 60 days from the date on which the order is communicated to him. So, you have to file an appeal to ITAT obviously. Against the CIT's order, the only option is ITAT. So, you go to ITAT, fill form number 36, and that has to be done within 60 days from the date on which the order is communicated to him. This is what this small question is all about. Question number 20. Question number 20 is giving us 4 different orders and asking us which is not appealable to CIT appeal. Now, I don't know about other, but one I definitely know that that order is not appealable against CIT appeal. Which one, sir? That is only the question. We need to find out which order is not appealable against CIT. A DRP order, a dispute resolution panel order which is passed under transfer pricing. So, if a dispute resolution panel, because that order is already passed by 3 commissioners, a collegium of 3 commissioners already passed that order, has given direction to the AO. So, against that order, go and check on in our easy notes also. Against the order of DRP, if you want to appeal, you have to go to ITAT. You cannot file with CIT appeal. Check. Therefore, you have to go to ITAT to file. Apart from this, against this, and against the 4th one, you can go to what? CIT appeal and file an appeal. But against the order of dispute resolution panel, you cannot go to CIT appeal. You have to go to the ITAT. That is the higher authority for. Next, question number 21. There are 2 persons, Mr. X, who is aggrieved by the order of AO, and Mr. Y, who is agreed by the order of Director General. So what is the remedy? So if you are agreed by the order of AO, go to CIT appeal within 30 days. Within 30 days of the date of receipt of notice of demand. Whenever you receive the notice of demand, you have to go within 30 days. And if you are agreed with the order of Director General, which is one of the highest authority in the income tax law, then you have to go to ICAI, because against Director General you cannot go to lower authority. Na? CIT appeal is lower than Director General. So in that case, you have to go to what? ICAI within 60 days on the days on which you have got the order, whenever the order was communicated. So against the order of AO, you have to go to CIT appeal within 30 days, and against the order of Director General, you have to go to what? You have to go to the ICAI within 60 days. Check it, please. Question number 22. What is happening in this question? There are two disallowances which AO has made. One is some tedious disallowance of 3 lakh rupees, and one is from an unexplained credit, etc. disallowance of 4 lakh rupees. So against this unexplained credit, you went to CIT appeal, okay, and you went to CIT appeal. Matter is decided over there. Now, if you want a remedy against this first one, what can you do? Can you go to appeal? You cannot go to appeal because the time limit of appeal has gone. Can you go for revision under 264? Revision under 264 is also not possible, because revision under 264 is comprising of what? Doctrine of complete merger. It means what? If any matter is subject to appeal, the entire order cannot be subject to what? Subject to revision. The doctrine of complete merger is that 264 is also not possible. The only remedy which is available with the assessee is the assessee can go to what? Rectification under 154 if this is an apparent mistake. So if there is a mistake apparent from record, then the assessee can go for what? Rectification under 154. Appeal not possible because time limit gone. Revision under 264 not possible because doctrine of complete merger. Even if a single matter is appealed, you cannot go for revision under 264, but 154 is possible, subject to what? It's an apparent mistake. Question number 23. In this question, what has happened? Mr. Mahesh, who is found to be owner of 2 gold chains of 50 grams each. The value of each chain is 1,45,000 rupees, and that is undisclosed. Now the department wants to charge tax under 115BB for that undisclosed asset. Now how much tax they charge? You know, 78%. How? 60% tax under 115BB plus 25% surcharge plus 4% cess. If you take calculator, it comes to 78%. So 1,45,000 for one chain. Like that, there are 2 chains. So for 2 chains, it is 2,90,000. 2,90,000 is your disclosed income. Charge 78% tax on that, and that will come to how much? That will come to 2,26,000 rupees 200. 2,26,200 rupees will be the 78% tax of 2,90,000. Check it, please. Question number 24. Now there are 2 persons over here, Mr. Ganesh, Mr. Rajesh. Both of them are resident. Mr. Ganesh is born on 1/7/1962. Therefore, he is a senior citizen, and therefore for him the basic exemption limit would be 3 lakhs. Mr. Rajesh is a super senior citizen because he was born on 1/4/1943. Therefore, he has attained 80 years age now, and therefore he is a super senior citizen. Now, for super senior citizen, the basic exemption limit is 5 lakhs. Up to 5 lakhs, there is no tax. Okay. Now, both of them have not furnished the return. Both of them have not furnished the return. Now, the total income, if you do not furnish the return, the income will be assessed as per best judgment assessment. So, in case of Ganesh, the total income is 8 lakh, and in case of Rajesh, the total income is 5 lakhs. Now, we need to compute the penalty. Now, let me tell you very clearly, Rajesh will not be liable for penalty. Why? Because for Rajesh, the basic exemption limit is 5 lakh and he is not showing income up to 5 lakh. So, why the hell he will be liable for penalty? For me, the basic exemption limit is 5 lakh, for example. Okay. I am Rajesh, I am super senior citizen, and I am earning 5 lakh only. I will not be liable for any penalty because I am not liable to pay any tax only. Okay. Now, but in case of Ganesh, yes. For Ganesh, you have to compute the underreported income. What is underreported income? It is income assessed minus basic exemption limit, which is 5 lakhs. So, you have to first write down income assessed 8 lakhs minus basic exemption limit, which is 5 lakhs. And then this is the underreported income. And then you have to compute tax not on 5 lakhs. That is the catch. Then you compute tax on underreported income plus basic exemption limit. That you have to compute tax on 8 lakhs. So, if I compute tax on 8 lakhs, it comes to 72,800. You can compute that up to 3 lakhs exempt, then 2 to 3 to 5, it is 5%, then above 5, then it is 20%, and so on and so forth. So, you will get what? 72,800, and accordingly 50% penalty of that will come to 36,400, and therefore the answer is Ganesh is liable for a penalty of 36,400, but Rajesh is not liable because Rajesh income is not exceeding the basic exemption limit. Check it, please. Next question is also based on that. Dinesh is a person who is aged 47 years. He has not filed the return. So again, if he has not filed the return, the income will be assessed as per 144. And how will you compute underreported income? income assessed minus the basic exemption limit. So here the underreported income is 15.5 lakhs. Again, remember, don't forget this catch. Now, while computing the tax, you will not compute tax on 15.5. You will compute tax on underreported income plus basic exemption limit, that is tax on 18 lakhs. So compute tax on 18 lakhs, you will get 3,66,600. Take 50% of that, you will get 1,83,300 as your what? As your penalty. Check it. Therefore, the answer to this question is point number C. Question number 26, which is based on 269 SS and 271 D. What has happened? Mr. X is making a deposit of 12,000 in cash. You can accept 12,000 cash. The restriction on taking the deposit of 20,000 or more is not allowed. The restriction is on 20,000 or more, not on 12,000. So first, NBFC is taking 12,000 cash from you. It is allowed. You are not violating any provision. Then NBFC is taking 7,500 from you in bearer check. Then also you are not violating any provision. After this, you should not accept. After 20,000 or more, you should not accept amount by account other than account pay check, account pay draft, ECS or such other electronic mode. So far 20,000 is not exceeding. It's all fine. Everything is fine till here. Now, when I receive the third amount, I receive by account pay check. I did absolutely correct, and therefore I am not violating any provision. None of the provisions are violated because my other than account pay check, account pay draft, ECS, such an electronic mode does not exceed or equal to 20,000. It is within 20,000 limit, and if the moment it goes beyond 20,000, I accept the payment by account pay check. Therefore, no penalty will be attracted in this case under 271D. Check it, please. Next question is of transfer pricing penalty. That is, if a person fails to report an international transaction, then what are the penalties that can be imposed? Two penalty can be imposed. First, if a person fails to report international transaction, then 2% of value of transaction under 271AA. Okay. And apart from that, 200% of tax payable, because if you fail to report an international transaction, that is treated as what? That is treated as a under-reporting of income, and therefore if it is it's treated as a misreporting of income, and because it is treated like a misreporting of income, you will be liable for 200% of tax payable also. So if you do not report a transaction in transfer pricing, there are two penalty which you have to bear. First is the penalty of transfer pricing, that is 271AA, 2%, and second is the penalty which is we have done in the chapter of penalty, that is misreporting of income, that is 200% of tax payable. Okay. Question number 28. A non-resident is there, 61 years age, has not furnished the return of income. Now his income is assessed under 144 as 13 lakhs. So how much penalty will pay? Same formula. Underreported income will be equal to income assessed 144. How much assessed? 13 lakhs minus basic exemption limit of 2.5 lakhs only. Sir, but this person is 61 years. That benefit of 3 lakh and 5 lakhs is not available to non-resident. It is only available to resident, and resident. Therefore, 13 lakhs minus 2.5 lakhs comes to how much? 10.5 lakhs. This will be your underreported income. Again, while computing tax, you will not compute tax on 10.5. You will compute tax on 10.5 plus 2.5. That is on 13 lakhs only. So, on 13 lakhs tax comes to 2,10,600. On that, you will take 50% tax, 50% penalty, sorry. And on that, you will get the answer as 1,05,300. Okay. So, this provision of 144 and penalty is repeating again and again. Now, next question is on marginal relief. What is happening? This company is earning 10 crore 1 lakh rupees. Now, for earning 1 lakh extra, now we all know that if the domestic company is earning up to 10 crore, then the surcharge is 7%. And if it is earning more than 10 crore, then the surcharge is 12%. So, just because they are earning 1 lakh extra, they will be having to pay surcharge of 12% on their entire tax. Because of that, what happens? You are earning extra income lesser as compared to extra tax. So, for earning 1 lakh extra, you are paying lot of tax. Let me give you an example. First of all, for that purpose, how to compute marginal relief and tax payable in that case, let me explain you. First of all, you have to see what is the tax on 10 lakhs, tax and surcharge. So, what is the tax and surcharge on 10 lakhs? First of all, let's see the tax rate of this company. The turnover of this company of last to last year is less than 400 crore. Now, because the turnover of this company of last to last year is less than 400 crore, therefore, the rate of tax of this company is only 25%. Okay. Now, because it is 25%, listen carefully. Now, first compute tax on 10 lakhs. How? 25% plus 7%. Compute the tax. It comes to 2 crore 67 lakh 50,000. Now, compute tax on your total income, 10 crore 1 lakh rupees. Now, when you compute tax on 10 crore 1 lakh, it comes to 25% plus 12% surcharge, and therefore your tax will increase drastically from 267.50 to 280.28,000. See, so for earning 1 lakh extra, you are going to pay approximately 13-14 lakh extra tax. What sense does it make? So the government gives you marginal relief. Now there is a very simple way to compute marginal relief. What it is? Whatever tax comes over here now on 10 lakh, just add the extra income to that. That's it. That will be your tax, and then add 4% to that. Let me explain you once again. I have done all this thing in class also. I have told you, we have done questions also. Whatever tax comes on your 10 crores, don't compute this tax only. It's of no use. Whatever tax comes on your 10 crore, just add extra income to that. How much extra income you are earning? 1 lakh. Add that, and then 4% says. 4% says, once you do that, you will get your answer as desired answer. Whatever is the correct answer, you will get that. Check it. 279,24,000. You can compute it in your hand. Whatever tax on 10 crore, take that plus extra income plus 4% says. That's it. You will get the answer. Similarly, next question is also based on that only. Company is not following 115 BAA. Okay. Question number 30. Now, this company's last year turnover is 410 crore. Therefore, the basic tax rate of this question will come to 30%. Okay. Now, what you will do? The company is earning 10 crore 2 lakh. So, what you will compute? First, compute tax on 10 crore. How much? 30% plus 7% surcharge. The tax comes to 3 crore 21 lakh. Now, don't do anything. Just add extra income to that. Add extra income of 2 lakh rupees. Whatever amount will come, add 4% cess, and you will get your desired answer. Check it, please. 335.92. You will get the desired answer. It will be like that. It's as simple as this. You don't have to unnecessarily follow a longer route to get this answer here. Question number 31. This question is based on 115 QA. Here there is an Indian company who is buying back its own shares from the shareholders. So in that case, what happens? If the Indian company is buying back its own shares from the shareholder, then the company is liable to pay tax, distribution tax at the rate of 23.296%. Company is liable to pay tax on 23.296% on of the distributed income. And how to compute the distributed income? There is some rule which is given by CBDT under Rule 40BB. That how to compute the distributed income. Moral of the story, if I am a domestic company, Indian company, and I am buying shares of my own shareholders, I am buying back the shares, company is liable to pay 23.296% tax, and the shareholders are exempt under 1034A. Check please. Check. Okay. Now next question. Next question is based on ATM. What happens? What happens in ATM? ATM is applicable to domestic company, and it says that whatever dividend is earned by the company from another domestic company, from foreign company, or from business trust, compare that with the dividend distributed by the company 1 month prior to the due date of filing of return. So whatever dividend earned during the year, compare with the dividend distributed to its own shareholders 1 month prior to the due date of filing of return. Whichever is lower, that much will be allowed as deduction under ATM. So now we will see how much dividend is earned by the company. Now company has earned, first of all, dividend of 108 lakhs from another domestic company, but that is net dividend. Net means that is after TDS. So gross that up. If I gross up with 10% TDS, because on dividend the TDS rate is 10%. If I gross that up, that comes to 120 lakhs. Okay. Apart from that, the company has also earned dividend of 30 lakhs from foreign company. So total dividend earned by the company is 150 lakhs. Now, how much dividend company has distributed to its own shareholders before the due date of filing of return? That is 1 month prior to the due date of filing of return. If the due date of filing of return is 30th November, you have to distribute till 31st October. If the due date of filing of return is 31st October, you have to distribute till 30th September. So, how much they have distributed? They have distributed 130 lakhs. So, they have earned 150 lakhs during the current year, and they have distributed 130 lakhs, and therefore, they will get deduction under ATM of 130 lakhs, as you can check over here. Is it clear? I hope these MCQs are helping you all to a great extent, and it's saving your time, more importantly, because saving your time is very important at this moment. Saving my time is not important. My time is not that relevant actually than what your time is. Your time is absolutely critical. So I am trying my best to save your time to the extent it is possible. Whatever I could do from my side to save your time, I am trying to do that. Okay. Next, this is again based on 115 QA. There is a company which is buying its own shares. So what has to be done? So whatever amount the company has paid to the shareholders, how much amount company has paid to the shareholders? 23 lakhs minus whatever amount company has got from the shareholders as per Rule 40BB. How much the company has got as per Rule 40BB? 17 lakhs. Differential amount will be subject to 23.296% tax. So on 6 lakhs, you have to compute 23.296% tax, and that comes to 139,776. Sir, how 23.296 has arrived? Very simple. 20% basic tax, 12% surcharge, 4% cess. This is how 23.296% is arrived. So distributed income is how it is computed. There are 11-12 different cases, but fortunately in this question they are directly giving us the amount which is derived under rule 40 BB. You can check it once. Next is based on tonnage taxation. Now there are two companies, X Limited, Y Limited. Now in tonnage taxation you get the benefit of tonnage taxation, you get the certificate for 10 years. Now there are two companies. One company has an unexpired period of 8 years, another company has an unexpired period of 6 years. It means one company has completed 2 years, one company has completed 4 years. So therefore they have an unexpired period of 8 years and 6 years. Now both of them are getting amalgamated and they are forming a new company Z. So now the question is, what is the tonnage taxation period Z will get? Z will get 6 years or 8 years. So the government says that whichever is higher, that Z will be given. So what is the higher unexpired period? It is 8 years, and therefore Z will get what? Z will get an unexpired period of another 8 years after amalgamation of X and Y. Check it please. Next question, question number 35. It's a good question. This is a question which is based on calculation of AMT, alternate minimum tax. In this you have to make two calculation of tax, okay? And then you have to find out which tax is higher, and then you have to find out what is the AMT credit. So this associate is earning an income of 52 lakh rupees. So out of the 52 lakhs, 35 lakh rupees is allowed as deduction under ATIA. Therefore, the total income as per the regular provision will be 17 lakhs. So you have to first compute tax as per 17 lakh rupees for Mr. Hari. Now tax as per 17 lakhs comes to 3,35,400. You can make a calculation. Now you have to compute tax as per 115 JC. That is AMT. And in AMT, we have to compute the adjusted total income. What is adjusted total income? Whatever is the total income, add the deduction which is claimed under ATIA. So this here the total income, adjusted total income will come to 52 lakhs. Now be very careful. When you are computing tax as per AMT now, because the adjusted total income is greater than 50 lakh rupees, you have to take 18.5%, that is obvious, plus you have to apply 10% surcharge. Here we are not applying surcharge because as per the normal provision, the total income is under 50 lakhs, but as per AMT, the adjusted total income is exceeding 50 lakhs. So here you have to apply 10% surcharge and 4% cess. So that answer comes to, on 52 lakhs, you have to apply 18.5% tax plus 10% surcharge, 4% cess, and therefore that will come to 11,530. So your tax will be 11,530, and the differential between this and this will be considered as what? As your AMT credit. You can check. The tax between the AMT minus normal tax will be considered as your what? As your AMT credit. Check it please. Question number 36. It's a very good question. Once again, this assessee is earning lot of income. First, this assessee is earning some profession income of 1,45,000. Card game is earning some 1,50,000. 40,000 is earning interest on FD. And 9,000 is earning interest on saving bank account. Okay, now this person is a resident senior citizen. Therefore, first thing he will get this amount, the both of them as a deduction under 80TTB. Okay. Now these two amounts are allowed as a deduction under 80TTB. Now what is left? These two are left. Now this is not subject to chapter 6A because if you earn income from winnings, those incomes are not subject to chapter 6A. So this you have to pay tax directly. But this will be subject to chapter 6A of 1,50,000 rupees. But it will be restricted to how much? 145. Because you cannot deduct 150 out of 145. Therefore, this income will be subject to chapter 6A deduction. This income will be subject to chapter 6A deduction. And this income of 1,50,000 will be directly taxable at 30%. Therefore, your total income is just 1,30,000 rupees. You can check it once. That is 1,50,000, sorry, not 30. Now, this is a very intelligent question, question number 37. In this question, it is a question on charitable trust, whereby a trust has received total of 80 lakhs as donation, out of which 10 lakh is a corpus donation, and that is invested also in post office. So, if a corpus donation which is invested in post office saving a bank account, then that will be subject to what? Exemption. This 10 lakh is exempt. Now, what about the remaining 70 lakhs? Pay attention. In that remaining 70 lakhs also, 20 lakhs is anonymous donation. Let's talk about anonymous donation first of all. What is the treatment of anonymous donation? The treatment of anonymous donation is as follows. Anonymous donation minus 5% of total donation or 1 lakh rupees, whichever is higher. Now, what is total donation? Total donation is 80 lakhs. Take 5% of that. 5% of 80 lakhs will come to 4 lakhs. So, reduce 4 lakhs, and this 16 lakhs will be subject to what? This 16 lakhs will be subject to 30% tax. So, apply that 30% tax on this 16 lakh rupees. Okay. So, that is 499,200 plus 4% cess, whatever it is. Okay. So, that we have got it. So, anonymous donation treatment I have explained you. Now, let's talk about the treatment of the other donation of 50 lakhs. Other donation of 50 lakhs will come in a normal income statement. And now remember, whatever anonymous donation is getting exempt over here now, that is 4 lakh rupees. That is also added in the income statement of normal donation. Be very careful. This is the catch. The donation which is getting exempt over here will be added back to the normal income statement. And then 54 lakhs, you will get 15% exemption out of that, which is an ad hoc exemption that every trust gets. That will come to your 45 lakh 90,000. Out of that, 40 lakhs you have applied for the objects of the trust. So you will remove that, and therefore this will come to how much? This will come to 5,90,000. Now on this 5,90,000, this is the other income, apart from what? Your anonymous donation. So this will be subject to your slab rates. Slab rates will be 31,790, and 31,790 and 499 200. If you add back, you will get 5,30,920. It's a very intelligent question. Very. You can go back once again and read and listen what I have said you. First, out of 80 lakhs, 10 lakh exempt because it is corpus donation, and it is invested in the post office bank. You have to invest in the mode specified in 11.5. Now, the SSC has done that. 10 lakh exempt. Forget about that 10 lakhs. What about remaining 70 lakh? Out of that, 20 lakh is anonymous. 20 lakhs minus 1 lakh or 5% of total donation, whichever is higher. That is 4 lakhs. 4 lakhs you got exempt over there. Whatever is exempt in 115 BBC, that will be added to the normal income statement over here. And then 50 lakhs plus the exempt amount of 115 BBC, 4 lakh. 54 lakhs, 15% exemption, 45 lakh 90,000, out of which 4 lakh you have 40 lakh you have applied for the objects of the trust, and therefore your net income is 5 lakh 90. On that you apply slab rates, you will get 31,720. 31,720 plus this 499 200 will be your total tax. It's a very intelligent question. Question number 38 is a very simple question. This is a trust which has earned an income of 10 lakh rupees. So you have to add back 10 lakh rupees. It has also earned voluntary contribution of 15 lakh rupees. You have to add that back also in the income statement. So your total income is 25 lakhs. Of that you will get 15% exemption. So your 15% exemption, after taking 15% exemption, your income comes to 21.25 lakhs. Now out of that you have incurred some expenses. 8 lakhs you have applied for the charitable purpose. So you can take the exemption of that, and 4 lakh you have taken some loan and you are making the repayment of that loan. That can also be considered as application for the objects of the trust, and therefore the answer comes to what? 9.25 lakhs. So it's a very routine question, very simple question, nothing great as such. Whatever income you received, add back, take 15% exemption, and whatever application made less, then you will get your final income. Check it once. Now next question, question number 39 is based on section 11 subsection 7, which is also for trust, which says that once you are registered as a trust under 12AB, then you will not get any exemptions under section 10 except 10(1). You will get 10(1), except 1023C and except 1046. Except these 3 exemptions, you are not going to get any exemptions under section 10 if you are registered as a trust. Now this trust is registered as a trust and has earned some agriculture income. So this will be exempt. Apart from that, it has also earned some interest on bonds of local authority, which is generally exempt under 1015. Now this exemption the trust will not get, because trust can only get 3 exemptions: 10(1), 1023C and 1046. Trust is not eligible to take any other exemptions under section 10 except these 3. Therefore, this exemption of 1015, which is interest on bonds of local authority, will be taxable in the hands of trust. Check it please. Now, question number 40 is the charitable trust is giving donation to another charitable trust, and the donation is a voluntary contribution, not corpus contribution. That is good, because if you make a corpus contribution, then corpus donation is not allowed as a deduction under the income tax law. Only the voluntary donation is allowed as deduction. That too, it should be out of its current year income. It should not be from accumulated income, and it should be given to another trust which is registered under 12AB or institution which is registered under 1023C. So if you want the deduction of donation, you have to fulfill the following condition. First, you have to give voluntary donation. Second, you have to give out of your current year income. Third, you have to give to another trust which is registered under 12AB or another institution which is registered under 1023C. Therefore, the first condition is fulfilled. It is not a corpus donation, it is a voluntary donation. Second, it makes donation to another charitable trust out of its current year income. It will be allowed. It makes donations to another education institution under 1023C out of its current year income. That will also be allowed. It makes donation to another charitable trust out of its accumulated income. Not allowed. Therefore, the answer to this question will be 1 and 2, and therefore the answer to this question is point number C. You can check this over here. Now, what would be your answer to question number 40 had the voluntary donation to the said trust or institution be in the form of corpus donation? What would be your answer if this donation is a corpus donation and not a voluntary donation? Then nothing would be allowed to you. In that case, nothing would be allowed, because the government says very clearly, if you make a donation as corpus donation, then it is not allowed. Only a voluntary donation is allowed as deduction. Be very careful. Okay. Now, next question is based on real estate investment trust. That is your business trust topic. Now, business trust has earned the following incomes. Let's talk about one by one. The taxability in the hands of the REIT and in the hands of investor, and whether the REIT is liable to deduct any TDS. We need to answer all these questions. First of all, if a REIT earns rental income, then it is exempt in the hands of REIT and it is taxable in the hands of investor, and therefore the REIT, while making the payment, has to deduct the TDS. Okay. Interest income from SPV, it is exempt in the hands of REIT, it is taxable in the hands of investor, and REIT, while making the payment, has to deduct TDS. Okay. Now, dividend income from SPV, always exempt in the hands of REIT, always exempt, always in the hands of REIT. If the REIT earns some dividend from SPV, it is always exempt. But what will be happening with that dividend in the hands of investor? That can be exempt, that can be taxable. Now, that depends upon one factor. What is that factor? If the SPV has taken the advantage of 115BAA, that is concessional rate, then the investor has to bear tax on dividend income. And if the SPV has not taken the advantage, then the investor can take advantage. Now, in this question, the SPV has not taken the advantage. Therefore, this dividend income is also exempt in the hands of investor. If SPV would have opted for 115BAA, then this would have been taxable in the hands of what? Investor. This is a very important point which you have to keep it in your mind. Last but not least, capital gains is always taxable in the hands of REIT, and therefore it is exempt in the hands of investor, and REIT will pay tax at MMR, MMR and MMR. So this is the taxability which is the exact taxability, and which is mentioned in point number 4 and point number 5. You can see only income number 4 is taxable in the hands of REIT. Yes, income number 4 is taxable in the hands of REIT. Income number 1 and 2 is taxable in the hands of unit holder. Yes, income number 1 and 2 is taxable in the hands of unit holder. Income number 3 is exempt in both the hands. Yes, income number 3 is exempt in the hands of REIT also, in the hands of investor also. And therefore, because income number 1 and 2 is taxable, TDS is deductible in case of income number 1 and 2, and because income number 3 and 4 is not taxable in the hands of investor, there is no need to deduct any TDS in that case. Check it please. It's a very, very, very beautiful and intelligent question. Okay. Now, next question number 43 is talking about that dividend treatment only. I am a REIT, I am receiving some dividend from my SPV. In the hands of REIT, it is always exempt, always. But in the hands of investor, it depends upon whether the SPV has taken 115BAA or not. If the SPV has taken 115BAA, in the hands of investor, dividend is taxable. If the SPV has not taken 115BAA, then in the hands of, again I am saying, in the hand, if SPV has taken 115BAA, if it has taken 115BAA, then taxable. If it has not taken 115BAA, then dividend is exempt, and that is what answer is, point number C. You can check it once. Okay. Next, question number 44. What is question number 44? Question number 44 talks about again REIT. REIT is earning multiple income. First, they are earning some rental income. So, rental income exempt in the hands of REIT, taxable in the hands of investor. REIT will never pay tax on rental income from land and building. That is passed on to what? Passed on to the investor. Second, short-term capital gain. REIT will pay tax at MMR. Investor will pay tax, no tax. Investor exempt. REIT will pay tax at MMR, investor exempt. Third, interest income from SPV. Interest income from SPV exempt in the hands of REIT, taxable in the hands of investor. And therefore, you can see here the answer to this question is point number D, because in case of interest and in case of rental income, REIT will pass on that to what? To the investor. Yes or no? And in case of short-term capital gains, REIT will pay tax at maximum marginal rate. You can check it once. Question number 5, again it is on dividend income from REIT. So once the REIT earns dividend income from SPV, in the hands of REIT it is always exempt. Be very careful. In the hands of investor, depends. If the SPV has opted for 115BAA, it has opted, then taxable. If it has not opted, then exempt. And if it has opted for 115BAA, then taxable, and if it is taxable, then deduct TDS also. So this is what the answer is. Point number 3, point number 6 and point number 9. Why? Because rest of the points are absolutely not relevant in this question, are wrong, are absolutely incorrect. How, sir? Let me explain you whatever I have said you in the last 2 minutes. REIT will enjoy the pass-through status of dividend. Dividend will be passed on to the investor. REIT will never pay tax on the dividend, irrespective of what? 115BAA or not. Yes, in the hands of investor it is exempt if the company does not follow 115BAA, and you have to deduct TDS if the company opts for 115BAA, because if the company opts for 115BAA, then it is taxable in the hands of investor, and if it is taxable in the hands of investor, while making the payment you have to deduct the TDS. This is what this question is all about. Beautiful question. Now this question number 46 is also a very intelligent question, and that is what? This is a person, Mr. A is an investor, and he has invested in 3 different places. Investment fund, he has invested 5%. Real estate investment trust, he has invested 10%, and securitization trust, it has invested 7.5%. Now we need to identify what is total income. First of all, let's talk about one by one. Investment fund. In case of investment fund, on PGBP income, fund pays tax, investor does not pay tax, therefore investor will not pay tax on this. But yes, on the other 2 things, investors will pay tax. On this other income, investor will pay tax. So other income, 5% of 2 lakhs will come to 10,000. Okay. And this loss, can this loss of long-term capital gains be passed on to investor? Yes, it can be passed on if the units are held for more than 12 months. You can see over here, since the units are held for more than 12 months, this can be passed on to the investor. So 12 lakh 50, 5% will come to 62,500, and the investor can set off this 62,500 against its other capital gains of 2,70,000. Therefore, this 2,70,000 will be set off against 62,500. And why am I giving this loss to the investor? Because the investors are holding the units for more than 12 months. If the investors of investment fund are holding the units for more than 12 months, then it is covered under what? Then it will be set off against what? Then it will be passed on to the investor, and the investor has been getting that benefit. Next, coming to real estate investment trust. Now we have done a lot of questions just now based on real estate investment trust. On rental income and on interest income, it is the investor who pays tax. Fund is not subject to pay tax. That is, REIT is exempt from rental income and interest income. But these 2 incomes will be taxable in the hands of investor. Yes, REIT will pay tax on this. Therefore, the above 2 incomes, 10% of that will come to 1,80,000 rupees will be taxable in the hands of the investor. And last, on securitization income, the entire income is taxable in the hands of investor. That is what? That is 6 lakhs into 7.5%. So that is entire income which is taxable in the hands of investor. So if you add up all these things, you will get the answer as 4,42,500. Don't forget to reduce 60 to 500. You have to reduce that because that much loss will be set off against your long-term capital gains of 2,70,000. So what I have said, I'll just repeat it once. This 5 lakhs, fund will pay tax because PGBP income, fund pay tax. This investor will pay tax, 5% investor. This investor can take because the units are held for more than 12 months. So give this loss to investor. Investor will set off against its other capital gains. This investor will pay tax. This fund will pay tax. Okay, that is REIT will pay tax. So give the first 2 points to investor. That is 10% of that. And this also investor will pay tax. So add 10,000 plus 1 lakh plus 80,000 plus 45 plus 270 minus 62,500 will give you 4,42,500 rupees. Okay. Question number 47 is based on the equalization levy of 2020. That is Finance Act 2020 equalization levy, which is applicable on e-commerce operator who are non-resident and does not have a PE in India, and their sale from India should be greater than or equal to 2 crore rupees. Then only they are liable for equalization levy. So in this case, their sale should be to what? To residents in India or even to the non-residents. But if you are making the sales to non-resident, then they should use the IP address located in India because it should come in the specified circumstance. So there are 2 things which are covered. Once, when you sell the goods to non-resident. When you sell the goods to resident, that is covered. Second, when you sell the goods to non-resident in special circumstance. What is special circumstance? Whereby the non-resident is using the IP address of India to book the orders. Then it is covered in India. So in this case, let's talk about ABC. 138 lakhs, yes, it will. We need to first of all find out whether it crosses 2 crore or not. If it crosses 2 crore, then only equalization levy will be arising. So this is 138 lakhs, and out of this 285 lakhs, 63 lakhs is subject to what? IP address located in India. Therefore, 138 plus 63 comes to 201, which is exceeding or equal to 2 crore. Therefore, this company is liable for equalization. But this company, 126 lakhs, this is not subject to because this is to non-residents. Out of this will be covered. Now here the total is only 199 lakhs. Therefore, this company will not be liable for equalization levy under 165A, that is PQR and company will not be liable for equalization levy. Check it please. Therefore, ABC and company is liable, PQR and company is not liable. You can check it once. Okay. Now, question number 48 is a test of whether 2016 equalization levy will be applicable or 20 equalization levy will be applicable or both will not be applicable. Now, let me tell you, 2016 equalization levy first of all is not applicable. Why? Because Mr. Rajesh is a resident who is an employee of a company, and if he is an employee of a company and if he is making a payment for online advertisement, then it is not applicable, because 2016 equalization levy is only applicable if you are making a payment for the purpose of business and profession, and Mr. Rajesh is not engaged in any kind of business and profession, and therefore the amount paid for an online advertisement by Mr. Rajesh will not be subject to equalization levy. So what about the 2020 equalization levy? 2020 equalization levy is also not applicable, because here the total gross receipt of that particular foreign company is not equal to or exceeding 2 crore rupees. It is just 1.8 crore. Therefore, 2020 equalization levy is also not applicable. Is it clear? Now, this question number 49 is also a beautiful question. Let me give you a synopsis of this question first of all. There are two companies, A Limited and B Limited. A Limited has no branch in India. B Limited has a branch in India. Therefore, this company will not be liable for equalization levy, because this company has a branch in India. So, company which has a permanent establishment in India, they are not liable for equalization levy. They will pay income tax. Now, what about A Limited? In case of A Limited does not have a branch in India, and a person is making a payment of 1 lakh rupees to that A Limited. Is the 2016 equalization levy applicable? 2016 equalization levy cannot be made applicable, because 2016 equalization levy is applicable if you make the payment of greater than 1 lakh rupees in the financial year. If you make the payment of exactly 1 lakh rupees to A Limited, which is mentioned over here, then 2016 equalization levy is not applicable. But is 2020 equalization levy applicable? The answer is yes, because the 2020 equalization levy is applicable, because this non-resident is doing what? Is having a website, and it's an e-commerce operator. It does not have a PE, and the turnover is also greater than equal to 2 crore rupees. Therefore, 2020 equalization levy is applicable for A Limited. So, what is the final answer? B Limited is not liable for equalization levy. A Limited is liable for equalization levy at the rate of 2% as per Finance Act 2016 165A. Check. Okay. Is it clear? And the last but not least, question number 50, which is talking about there is a foreign national, that is a citizen of USA, who is coming to India for some work, for rendering some services. Now, whatever remuneration he will get for rendering services in India is exempt subject to some condition. Condition number 1, that foreign company should not have done and should not have any business or trade in India. This is the first condition. Second, that person should stay in India for maximum 90 days. It should not exceed 90 days. Third, that foreign company should not claim that remuneration as a deduction. So, this is the condition, this is the condition, this is the condition for exemption. This is not a condition for exemption. It is nowhere written in the provision that the employee should not be engaged in any trade or any business. Employee can do other trades and business in India. There is no harm in that. But the company should not be engaged in any trade or any business in India. Then it is exempt under section 10(6). Okay. So, this is what these 50 MCQs are all about. I would like to say once again for you all my dearest student of where? Of South India. All my dearest student of South India. I would like to again tell you that apart from this booklet, you also have to do the booklet of May and November 22, which is beautiful. I will try my best. I am not making 100% commitment, but I will 100% try. Okay, that I will give an explanation for that also. That is a very big book. 297 MCQs are there. With what? With the case scenarios. I will try my best after 20th. First, my priority is to give you revision videos. Till that time, you can try this also. You can start trying with this. If you are not getting any answer, we will try to address that from the second, third week of this month. Okay. So that's it from my side. Apart from this, your revision videos are also coming very soon. Your first revision video is already uploaded. This time we are revising along with the practical questions also. Along with that, I will also try to upload your RTP discussions, the latest RTP of May 23. Along with that, I also try to put the latest mock test paper discussion whenever it comes in English. All of them in English. All of them in English. Don't worry about it. Okay. So take care all of you. Just do one thing. Share this video with as many friends as you can who understands English. Okay. And who wish to learn direct tax in great detail in English. Take care all of you. Bye.